You can think of a trade in three stages: initially entering, managing as it runs, and then finally exiting. When should you use a limit versus a market order? Learn from my mistakes. I've lost thousands of dollars in the past because I picked the wrong one. There are over a dozen types of orders. We'll go over the pros and cons of each and explain them with chart examples. Here we're on Comcast and see prices often reacted right around $30.50. Resisted price a couple times, fake out, more consolidation, rejection before price finally found support. Came back and retested this level, big push to the upside. Came right back and slammed on the brakes before continuing even higher. Now we're in a bit of a retracement and think we can catch it at $30.50 and ride it back up again. We put in a limit order and see what happens. Price teases us a few times before running to our target. We were right about the direction, but it doesn't do us any good because our order was never triggered. The other issue you can face with the limit order is only getting a partial fill. Here, everybody's watching this level. It barely touches. You get filled for 25 out of your 200 shares. Price bounces up right away. At least you made a little something, but it's a lot less than the profit you were planning on. The benefit of using a buy limit is you get exactly the price you want. The drawback is you're unsure how many shares will actually go through. If you want to make sure your entire order gets filled, you would buy at the current market price. We're close enough to support, we don't want to wait any longer. Looking at 2.671, and that's good enough. Current price is $34.37. We tell our broker to buy 200 shares. What ends up happening is you get filled at $34.57. The trade now offers a 2.5 to 1. There's two reasons for this. In a fast-moving market, the price is constantly changing. By the time you hit the buy button to when the broker sent the order, price continued moving up. Not so much on a liquid stock like Comcast, but the second reason is there's not enough volume to fill you at one level. Let's look at the 5-minute chart for Trivago. Obviously, this is an awful looking chart, and I wouldn't touch it with a 10-foot pole. But let's say you just know it's going to the moon and you want to buy 10,000 shares. Since there are so many gaps on the chart, you want to be careful when you set a limit order. The first 5 minutes, you only fill 500 shares. You're sitting there after 15 minutes and you've only bought 1,500 shares. You get impatient and send a market order for 8,500 shares. Your broker will fill all 8,500 shares at the best available price, but also at any price. We move up to $1.53 and pick up another 1,000 until all those sellers run out. Fill another 1,000 a little higher, but still have a ways to go. We clear this level for another 1,000 and a few more scattered orders. Brokers buying like a madman until we finally have all 10,000 we want. The last buy was 9% higher than the first, and that's where slippage comes from. Previously, we set a limit order and we just hoped it continue lower and then turn around. You might have noticed we have a lower high and price has basically been straight down ever since. It's easy to put too much faith in one support line, see price trigger you and then crash right through your stop. Some traders are not so much concerned with getting the best price. Instead, they rather have more confirmation and a higher win rate. This trader thinks price should go up, but he doesn't want to commit until it actually does. Price would turn around and only right here would he want his order sent. So far, we've talked about a buy limit and a market buy. This type of order is called a buy stop. This large green candle looks significant, and if price can make it above this, we don't expect it to go below the bottom of this candle. Next candle is below our entry, so we're not in the trade yet. Second green candle is close, but we're still not triggered in. Only now that prices cross the line does the broker send the 200 share order. This is essentially a delayed market order, so everything we just mentioned about market orders still applies. Our entry was at $36.99. Slippage will most likely only be a few cents, but being overly dramatic, let's say we get filled at $37.50. The pros of a buy stop are we get filled in the direction we want. We think price is going up and we get filled as price is going up, as opposed to a limit order where price is going down. As long as you're trading something with a decent amount of volume, slippage is usually a very minor issue. Let's stay with Comcast, but look at it from the perspective of entering a short. We can enter right now with a market sell. Second type is the limit order that'll be triggered when price retraces. We might decide we only want to go short if it gets below the recent low. Running the action out, we see take profit was hit. Let's go back and look at what would happen for each order type. With the market, we get in right away at the crosshairs. As I mentioned before, the risk of a limit order is you don't get filled, which is the case here. The sell stop is a little tricky. Our order triggered here, but notice the gap down. It's possible there could have been slippage, and we get filled down here. We have two more ways to enter a trade, the bracket and the OCO. As I start to talk about bracketed orders, allow me to get on my high horse for a minute. I've lost more money from this one mistake than everything else combined. Trust me when I say the worst thing you can do is not having a hard stop as soon as you enter the position. Sure, I'd have a mental stop loss. I'd buy here and tell myself when it gets down to here, I'll know what to do. Trade gets hit, well, let's give it a little more room to breathe, or even worse, I think it's at a discount and I'd add to my losing position. When your stop gets hit, you might be taking a nap, you might be in the bathroom, or maybe you're just emotional, a deer in the headlights, and you can't think straight. How you get into a trade, that's up to you. Whether you use a market order, a limit, a buy stop, they're all good options. But no matter which of the three you pick, you have to use a bracketed order with all three of them. If you want to be a winning trader, this is not negotiable. It's something you must do every single time. Okay, back to the chart. The risk to reward drawing is an example of a bracket order. What that means is your order price and stop loss are entered at the same time. We place our sell limit at 44.82 here. The very next candle, price goes up, and now our stop loss and take profit are active at the same time. If price goes up and we lose the trade, our buy order at 31.75 is canceled. If we win the trade, our buy order at 47.84 is canceled. I guess technically the bracket is a type of OCO, but now let's talk about the real power of the one cancels the other. You'll notice that Comcast has basically stayed on a tightrope for 29 days. A stock is like a spring that keeps getting compressed. Whether it's going higher or lower, your guess is as good as mine, but we know it can't be boxed in forever. An OCO is two separate bracket orders. If it breaks to the upside, we think it'll continue higher, so we set a buy stop. On the other hand, if it goes lower, we're betting price will continue lower, and we set a sell stop. Whether it goes up or down, we don't really care. We just want to get triggered in when it does break out. On the very next bar, the sell stop is activated, and along with it, the bracket order of the take profit and stop loss. And also the buy stop is canceled. To recap, essentially we enter with a bracket or OCO. As the trade progresses, we can use a trailing stop. We're halfway to our target, and the last thing we want is for the trade to go all the way back down and we take a full loss. Many traders will move the stop to break even, and every time price hits a new high, say $2 for example, the stop loss will move up $2. It's at this point that the broker will automatically move up our stop. So worst case scenario is we make $2 a share, but there's no cap on the upside if price wants to climb higher and higher. Here's the second time our stop moves up and we've locked in $4. Price keeps climbing higher and we keep locking in more profit. Price went up a little higher, but not enough to move the stop again, and we exit for a 2.42 R to R. As you can see, price ran up $5.50 higher than where we got out. Another way to trail your stop is to set a buffer from the current price. Even if price moves up a penny, the stop loss keeps right in step. As long as the yellow goes up, the stop loss goes up. In the green part, price doesn't make a new high, so the stop stays until we get triggered out at 90.31. For the record, I like the concept of moving your stop to lock in profits, but the execution of this method is not the way to do it. The main reason for this is because price is here, you set a trailing stop of $2. Looking left, you're ignoring all the previous candles in market structure and your stop is in an arbitrary place. I recently recorded a video that shows 4 better ways of trailing your stop. You'll learn about trailing with fractals, Heikin-Ashi, Chandler exit, and moving averages. If you want to know more, check the video here. We start to see price lose momentum and we're afraid of losing a lot of our open profit. So we arbitrarily decide we're willing to give back $2.50. This is where we get stopped out. It's not protected by the recent gap. It's just an amount we pulled out of a hat. In my trailing stop video, one of the 4 methods I teach is fractals. Fractals try to gauge using market structure, and as long as the market is making lower highs, we're in a downtrend. Stop goes slightly above the most recent arrow, and we keep trailing it all the way until price turns around. Here we exit for 3.5 to 1. If we choose not to get out with a trailing stop, your options are either a stop limit or stop market. Oftentimes resistance will turn into support. We decide to get long, stop below the recent cluster, and take profit near the high. We want to avoid the slippage and set a stop limit. 2 candles later, price goes through our stop and we have to be patient for price to go slightly higher before we get closed out. Initial stop was $1.80. Imagine kicking yourself for not getting out 349 days ago while you had the chance. Currently, we're in the hole $10.50, but consider yourself lucky because at one point it was much worse, at over 10 times the original stop. Using a stop limit might be fine 99 out of 100 times, but it only takes one bad trade for you to completely blow up your account. With a stop market, your order is executed as soon as price crosses. As we mentioned before, there may be a tiny amount of slippage, but it's a small insurance price to pay to make sure you're completely out of the position. In summary, for entries, you can use market, limit, or stop orders, as long as they're bracketed with a stop loss. Exits are always at market, not limit orders. The next order is less common but can be useful. It's called an if touched order. You can think of it in 2 steps. Here we want to set a buy stop, but price is really close. What we don't want is price to creep up, trigger us in, and then continue back down. It would be better for us if price retraces first, and only then if it turns back around will we get triggered in. Price hits this level, so now if it goes back up, hopefully it'll be carrying enough momentum and take us to the target. Comcast rises, our buy stop is activated along with the bracket order, and eventually we hit our take profit. Just for completeness, I'll mention the last 2 order types. You and me don't move the market. You have $10,000 of Comcast and you want to sell. It's a drop in the bucket and no one would even notice. Here you can see 85% of Comcast shares are owned by institutional investors and less than 1% by people like you and me. Looking at recent history, Amundi sold 821,000 shares, and at the beginning of the month, State Street bought 400,000 shares. At that size, you don't just send a market order. The slippage would be unreal. One option they have is for a fill or kill. They either buy 400,000 all at the same time, or they don't buy any. The different order types are really a balance between getting your order filled at a potentially worse price, or waiting for the price but risking not getting filled at all. As a general rule, for entering a trade, market stop or limit are fine. Just make sure they're bracketed with a stop loss. Speaking of stop losses, always use a market, not a limit order. Getting out of the position is the priority, and only a market order can do that. If you want to check out 4 ways to trail your stop to maximize your profit, click the video here. Or if you'd like to focus on risk management and tips to keep you from not blowing up your account, click the video here. Don't forget to subscribe. I'll talk to you soon.